What's the single best piece of investment advice I've ever received? It didn't come from a textbook, it came from a millionaire I admired as a kid. After hearing him talk about the markets, I was hooked, but as a beginner, I was lost, so I asked him the big question: how do I pick the right stocks? His answer was deceptively simple. He said, treat it like finding a lifelong partner. Think about it: when you buy a stock, you're not just buying a ticker symbol, you're buying a piece of that company. You're entering a partnership, and just like in a relationship, you want it to be happy, long, and successful. Now, I'm not one of those fake gurus who promise a crystal ball. There's no magic trick to pinpointing the next rocket ship stock, but there is a disciplined way to stack the odds heavily in your favor. It all starts with your strategy. In dating, your approach determines your results. The same is true for stocks. You have two primary strategies to choose from: technical and fundamental analysis. Technical analysis is for short-term traders. They live and breathe charts, looking for patterns to predict minute-by-minute price movements. Frankly, in my view, most are just glorified gamblers. Over 95% of day traders lose money. Then there's fundamental analysis. This is where you become a detective. You investigate the company itself, its financial health, its brand power, its leadership. This method isn't about getting rich tomorrow, it's about building wealth securely over 3, 5, or 10 years. If you're looking for a quick buck, this isn't for you. My goal is to help you secure your financial future. Let's say you're on a dating app. You check the profile pictures and bio for a company. That profile is its balance sheet. It's a snapshot of its financial position. Think of it like a cookie jar. The current assets are the cookies you can eat right now, cash and anything that can become cash within a year. The long-term assets are the cookies at the bottom of the jar, like their headquarters and equipment. Intangible assets are the secret ingredients that make the cookies great, like patents and brand value. Then you have liabilities. These are the cookies you've promised to give away, your debts. Here's a simple health check: divide total current assets by total current liabilities. If the result is above 1, the company can cover its short-term bills. For a company like Coca-Cola, this number is a healthy 1.13. It's a strong start, but our investigation is just beginning. Before you commit, you'd want to know someone's past, right? For a company, that past is written in its income statement, its report card. At the top, you have total revenue, all the money the business took in. Then, after accounting for the cost of making its products and its operating expenses, you get to the bottom line, net income. This is the actual profit. The key calculation here is the operating margin, operating income divided by total revenue, times 100. A margin of 10% is healthy, 20% is high. Coca-Cola, for instance, operates at an impressive 25%. But remember, past success doesn't guarantee future results. A company like Amazon lost money for years before becoming a giant. You wouldn't partner with someone who's terrible with cash. Companies are the same. The cash flow statement shows you if a company is financially responsible. It's split into 3 parts. Operating activities, money from its core business. You want this number to be positive. Investing activities, money spent on new equipment or facilities. A negative number here is often good, it means they're reinvesting for the future. Financing activities, money from loans or paid out as dividends. Be cautious if a company is borrowing heavily while paying huge dividends. It's unsustainable, like someone giving expensive gifts while deep in debt. Sometimes, everything looks perfect on paper, but there's no spark. For stocks, the spark is found in qualitative analysis, the factors that don't fit in a spreadsheet. First, brand recognition. Almost everyone knows and has an opinion on Apple. That trust is a powerful moat that protects it from competitors. Second, leadership research. The CEO and board, are they seasoned? Sensible? A single reckless tweet from a CEO can wipe billions off a company's value in a day. Third, competitive advantages. Does the company have unique patents, like Tesla's EV technology, or a loyal customer base? These are golden tickets for long-term growth. This research is time-consuming, but it's what separates the pros from the amateurs. Imagine hearing a nasty rumor about your partner and immediately breaking up without a conversation. That's panic selling in the stock market. When bad news hits, emotional investors sell first and think later. Remember the Facebook Cambridge Analytica scandal? The stock plunged 18%, but investors who believed in the company's fundamentals held on and were rewarded with gains of over 200% since then. The news creates noise. Your research reveals the truth. So, when should you sell? It's more about you than the market. Sell if you have a genuine financial emergency, if you've hit a preset financial goal, or, most importantly, if your deep research concludes the company's core fundamentals are permanently broken. You wouldn't marry the first person you date. You need to know what's out there in investing. The two main personalities are value stocks and growth stocks. Value stocks are the stable, reliable partners. They are often well-established companies in essential industries like consumer staples or banking. They are less volatile and often pay you dividends. Think of companies like Procter & Gamble. Growth stocks are the ambitious, high-potential partners. They reinvest all their earnings back into the business, so they rarely pay dividends. They are more volatile but offer the potential for explosive growth. Think Tesla or Nvidia. A quick way to tell them apart is the P/E, price to earnings, ratio. The market average is around 20 to 25. Value stocks tend to be below this, growth stocks above it. The key is diversification. Don't put all your eggs in one basket. A balanced portfolio should have stocks from at least 5 different sectors and more than 25 companies. This way, if one stock stumbles, your entire financial future doesn't fall with it. Mastering this process of fundamental and qualitative analysis empowers you to make informed decisions, not emotional guesses. You learn to pick business partners, not just stocks. It's a journey that requires patience and discipline, but the reward, a secure financial future, is worth it.